In many ways, my talk today is a footnote, actually, to what Barry Naughton talked about earlier on. And it's going to be a long footnote, but I'm going to, Barry talked about the enormous amount of leveraging that state-owned enterprises and local government investment vehicles engaged in starting in late 2008 going forward. I'm just going to provide a sort of a rough accounting of how much debt these entities have taken on in the past few years, and also draw some implications of that. So again, as we were talking about, as Clayton laid out very nicely at the beginning of this session, when we think of China, we think of a lot of assets, right? So the Chinese government is really good at projecting all the assets at its disposal to the rest of the world. We know China has a huge economy. We know that China exports a lot. And as a result, China also has a $3 trillion foreign exchange reserve. But one thing we have to understand about the foreign exchange reserve is that the entire $3 trillion is already balanced against a liability of $3 trillion worth of renminbi issued by the central bank, right? So for the central bank, that $3 trillion is balanced exactly by liabilities. Moreover, I'm going to talk about today, a lot of this renminbi then ends up being more or less debt that's owed by state-owned entities like large state-owned enterprises and local government investment vehicles. And ultimately, this debt is owed by the Chinese government. So when we consider the assets as well as the liabilities of China, China actually is not such an exceptional case of economic miracle after all. Okay, so what I do today is I look broadly at all the liabilities in the formal financial system, which excludes, of course, underground bank lending. In any event, underground bank lending turns out to not be so much these days. Most of the financing, most of the debt exists in the formal financial system. And so earlier on, there was a very technical discussion about, what is the difference between bank lending and social. It's actually 社会融资, so it's social financing. The big difference is not this underground bank lending. The big difference is actually bond issuance and also stock. So the 融资 also includes equity kind of fundraising, so stocks and also private equity increasingly. Then we examine who's ultimately on the hook for this what turns out to be an enormous pool of liabilities and who the creditors are. Turns out the ultimate sort of debtor of a lot of this debt is the central government of China. And part of the reason why banks are so happy to lend to local SOEs, central SOEs, and local development companies is because of the implicit guarantee of the central government behind all of these entities. And then we then infer some policy and welfare implications. Okay, so here's a table which is really hard to read, unfortunately. But if the first part is basically bank loans. Note that the unit that I'm presenting here is trillions of renminbi, right? So you read down the sort of second column from the left. That is the total amount of debt in various sectors, right? So in the top part, it's bank loans. In the middle is bonds. Toward the bottom, there's this category called illiquid bonds, which I can get into in the Q&A, but given the limit of time, I probably can't get too much into it. And then finally, at the bottom, at the very bottom figure actually got cut off, is triangular debt of state-owned enterprises. Triangular debt being debt that SOEs owe to each other. And so the unit here is in trillions of renminbi. The third column from the left is that number relative to China's nominal GDP in 2009, just to give you a sense of the scale. Sort of next to the last column is the ultimate debtor, so who is on the hook ultimately for this liability, and then finally who the main creditors are for these liabilities. So starting with loans, total loans outstanding in China is by now probably 50 trillion renminbi, which is sort of well over 1.5 times China's economy back in 2009. For 2010, probably still around that figure because loans is growing faster than the economy. About 1/5 of that is loans to households, so obviously the ultimate debtor is the household. But the next few categories, even though it's roughly estimated by myself and others, are loans to local investment platforms. These are companies set up by local government to finance public infrastructure. Instead of issuing bonds and explicitly taking onto this debt, most local governments in China will just set up a corporation and use that corporation to borrow money from the bank or to issue bonds. Even though in the Chinese accounting system that's counted as corporate debt, in reality that is government debt, right? Next we have loans to central SOEs, and how much there is in this category is anyone's guess. But I did this little exercise just for fun recently where I just, there are 110 or so central SOEs directly controlled by the central government, and I just went through the listed subsidiaries of just 10 of those companies and tried to figure out the amount of loans they have, and it turns out to be over 1 trillion renminbi, right? And I think when you add the loans and the debt of all of these central SOEs, and there are tens of thousands of subsidiaries in China, you're going to get a debt figure, a loan figure, loans to those entity figure of at least 10 trillion renminbi, but likely substantially more. But Barry probably knows more. Is anyone's guess in reality. And there's in the course of my research on local investment platforms, I also ran across a lot of loans to local industrial SOEs, and that amount is anywhere between 6 to 8 trillion renminbi. And then finally, you have loans to private, individual, and foreign corporations, and that's probably in the ballpark of 6 to 8 trillion renminbi also, right? So what you notice is that in the formal banking sector, most of the loans have gone to state-owned entities, and ultimately it's the central government which guarantees these loans implicitly, right? And so if anything happens to these entities, they go bankrupt, the banks will ultimately knock on the doors of the central government. When you look at the bond market, and the data for the bond market is much, much better, there's this website, China Bond, which is excellent, which keeps tracks of who's holding all the bonds, who's issuing all the bonds. Again, what you notice is that virtually all the bonds issued is issued by state-owned entities, right? So starting from the Chinese government itself, also the policy banks, policy bank bonds are fully guaranteed by the central government. Bonds issued by state-owned commercial banks also guarantee more sort of implicitly, but basically guaranteed by the central government. Bonds issued by central and local SOEs, short-term notes, and all of that totals almost 20 trillion renminbi, right? A substantial share of the economy. And so in recent 3 or 4 years especially, there's been a shift away from bank loans to bond issuance, and this is what accounts for the big discrepancy between the growth in credit and this 社会融资, the social fundraising figure, is actually bond issuance, which of course is not a loan, but is still debt, right, and mainly issued by state entities. There's a small category, turns out illiquid bonds, but is very important in the story of China's investment, which is that various special purpose vehicles like asset management companies and recently just a nameless SPV were set up in the past 10 years, which issued substantial amount of bonds, not relative to GDP, but still nearly 3 trillion renminbi worth of bonds, to recapitalize China's state banks. And this is how China's state banks are able to provide loans to all of these state-owned enterprises and local investment entities. For those of you who don't keep track of this kind of stuff, there's an excellent book on this topic which was published very recently by Carl Walters called Red Capitalism, and this book outlines all the mechanisms by which the banks in China were recapitalized. Finally, this chart got cut off, but basically what you notice recently in a lot of state-owned enterprises, even sort of very healthy state-owned enterprises like PetroChina, but especially local investment vehicles, when you read their regulatory filings and also bond rating reports, which I do obsessively, what you notice is that it will report huge increases in current assets, but the operating cash flows remains the same, right? So something very funny is happening, and year after year, you have current assets growing larger and larger, but then actual cash flows in the company, especially for its main business, remains the same more or less. And I've talked to people about this, and basically what is happening is that these SOEs are lending to each other and recording the lending as current assets, which then gets rolled over year after year. And then more and more lending happens. So the current assets actually grow year after year. So there's a huge amount of this. State asset is roughly 76 trillion renminbi today. I mean, is there an actual figure? I don't know. 76, 100 trillion, something in that order. And I roughly estimate that 15% of that is actually triangular debt, although it's really anyone's guess how much of it is triangular debt. Okay, so when you add everything together, it's a huge amount of money. It's 63 trillion renminbi, which is $9.6 trillion, 1.9 times China's GDP in 2009, 10 times total government income in 2009, and nearly 20 times central government income in 2009. So remember, ultimately, it's the central government that is going to pay. So in fact, there is a huge amount of liabilities balanced against this very impressive assets that we see in the $3 trillion US foreign exchange reserve. The good thing for China is that this will not cause a financial crisis in the near term, because all of this money is owed to domestic creditors, mainly banks in China. And the banks mainly owe their money to depositors who are onshore, right? So unlike countries that have experienced financial crises, the main creditor in this case is not offshore, but are onshore. But there are some very disturbing implications nonetheless. One is that the Chinese government has become very reluctant to raise interest rates as a means of fighting inflation, because they're the largest debtor, right? So if you owe the most amount of money in the entire economy, why would you want to raise interest payments on yourself? That could be a very simple-minded way of thinking about it, but for me, it makes total sense. Every basis point, so this is 100% increase in interest rates, imposes an additional 4.83 billion renminbi in annual interest payments. So recently, there was a 25 basis point rate hike enacted by the People's Bank of China that imposed 120 billion renminbi in extra interest payments on state-owned debtors. So as a result, rate hike is a highly undesirable weapon against inflation from the Chinese government perspective. The other implication is that it is my belief, and the belief of some others, that the reason why the Chinese economy is so addicted to liquidity is that the capital is being used very inefficiently, and a lot of projects that receive this leveraging actually is not generating sufficient cash flows to keep up with even interest payments. So as a result, to maintain the liquidity of the entire financial system, a lot of loans has to be rolled over. Right, so you can imagine, like, I borrow $100, and I have to pay, let's say, $6 in interest, but my business only earns me $3 in profit every year, so I'm not able to keep up with my interest payments. In the normal course of the event, I'm going to go bankrupt after a year or two. But in China, what happens is that I go to the bank and say, look, I can't keep up with my interest payment. But I'm an entity of the local government, work with me here. The bank then gives me a loan for $200. And then I use part of that to either repay principal or interest payments for my old debt, right? So a lot of this debt gets rolled over, but then now I owe the bank $200 instead of $100, right? And then so on and so forth. And over time, you can see that a lot of these, in reality, illiquid entities that are not earning cash flows will demand more and more liquidity from the banking system, right? So theoretically, actually, you can look at Kornai. This is a classic case of soft budget constraint, and capital is allocated very inefficiently. What we see empirically is a decline, is that the average maturity of debt actually lengthens over time, and I'll show you a graphic for that. Okay, so I'm kind of running out of time. Part of that can be explained by the rise of mortgages, which is just household debt. But I would argue that a large part of the reason why debt maturity has lengthened over time in China is that distressed debt is piling up in the financial system, and a lot of it is getting rolled over into long-term debt. To avoid non-performing loans from appearing on a large scale and a sudden slowdown in credit expansion, the PBOC must allow money supply to increase robustly every year, which is indeed what we've seen in recent years, which actually is what we saw year after year back in the old days, in the 80s and basically through the mid-90s. That's what we saw. There was this Zhongji years where liquidity growth drastically decreased for a few years, but then in recent years it increased drastically again. So the massive foreign exchange inflows, I would argue it's actually not a headache for the Chinese government, not a headache for the central bank. In fact, they're addicted to this liquidity and they need it, right? So this is part of the reason why they're so reluctant to revalue is that they actually want the foreign exchange reserve to grow very robustly every year so that money supply can grow without them seeming to print money. So back in the old days, back in the 80s and the early 90s, when China did not have a huge trade surplus, the central bank actually had to outright print money, expand money supply by printing money year after year to maintain the liquidity of the financial system. Now they don't have to do it because of FX inflows. What's very interesting is that to counteract this FX inflows, China issued these bonds to sterilize the inflow, and the amount of sterilization bond outstanding as a share of foreign exchange reserve has been dropping for the past 4 years, which I'll show you. So this also suggests Chinese government is reluctant to use stringent credit control, right? And then the implication of that is, again, this is why this is a footnote to Barry's talk, is that if you're not willing to impose credit restriction, if you're not willing to raise interest rates, what you're allowing is, and as structural factors raises interest rates in the coming years, what you're going to allow is some inflation every year in the foreseeable future of, I would say, at least 4 or 5%. And then if there is a shock, like there is right now with oil, it could go higher. So this is what I was talking about. The red line is share of medium to long-term loans in the banking system. It went up from roughly 30% in 2004, which is before the beginning of this graph, to 60% today. And the latest figure actually shows that it's accelerating. So when you look at new loans, medium to long-term loans is twice as large as short-term loans. The blue line is PBOC sterilization bonds outstanding as a share of foreign exchange reserve. That has been dropping, right? So there was a time back in 2007 when sterilization bond was 40% of FX reserve. It has dropped to actually below 20% today because in January, the PBOC redeemed a huge amount of these bonds without issuing new bonds to replace them. Okay, and so going in the future to maintain liquidity in the system, the PBOC will have to resume what's called re-lending, which is the printing of money. And you see a slight sort of increase in recent months, and my prediction is that as the trade surplus shrinks, re-lending operation will have to increase. Okay, so besides FX inflows and left hand giving to right hand, so the banks will buy each other's bonds, households are financing this enormous amount of debt. This is, okay, I'm really running out of time. This is a net household deposits, right? So this is household deposits minus household lending, and this figure has grown from 5 trillion to 20 trillion in the past few years. As a share of GDP, it maintains about 50% GDP. So this means that every year households, the equivalent of 50% of China's GDP in household deposits is given to the corporate sector, the state corporate sector. And households, meanwhile, is only borrowing something around 20% of GDP from the banking system. This contrasts very sharply with the US, which is the other extreme, where household debt as a share of GDP is 100%. Obviously, that's too crazy. But there was this kind of nice period in the US in the 70s and the 80s when household debt as a share of GDP was like 60%. And so to have consumption as the main driver of growth in China, I would argue that these two curves have to switch places. That is that household borrowing from the banking system needs to go up to 60% of GDP, and household deposit transfer to the state corporate sector needs to go down to around 20%. That is not a simple thing to do. This will require, the political economy of China to change drastically in the coming years. So these are the points I went over already. So final one point is that even though in the short term what the Chinese government is doing is relatively sustainable, but households, which is when there's high inflation, deposit interest rate is really low in China. Households are paying 600-700 billion renminbi in inflation tax to the government by putting money in the banking sector because they're earning negative real interest payment from the banks. This motivates households to really aggressively look for opportunities to make a high return. Right now, real estate in China is still the best thing that they know to beat inflation. But if anything happens to real estate, they're going to begin to look for investment opportunity offshore. And so by maintaining inflation rates so high and interest rates so low, it really provides a structural foundation for capital flight from China. Thank you very much.